Let's get right to it. We're going to demystify the world of investing. It's a topic that can seem complex and overwhelming, but it's actually quite straightforward once you grasp the fundamental concepts. We'll walk through it together, ensuring you have a solid understanding. So, what is investing? At its core, investing means putting your money to work. It's about strategically allocating your funds into assets with the expectation that they will generate income or appreciate in value over time. So it grows over time instead of just sitting in a savings account where it might earn minimal interest or even lose value due to inflation. Investing is about being proactive with your money. The goal: build wealth, create a financial safety net, and achieve your long-term financial aspirations. Outpace inflation, which erodes the purchasing power of your money over time. Investing helps you stay ahead of the curve and secure your financial future. Whether it's retirement, a down payment on a house, or your children's education, investing can help you reach those milestones. Think of investing like planting a seed. It requires an initial investment of time and resources. With patience and care, it can grow into a tree, nurtured by consistent effort and attention. That produces fruit year after year, providing a sustainable source of income and value. The magic behind this growth is compound interest, a powerful force in the world of finance. Your returns start earning their own returns, creating a cycle of growth that accelerates over time, creating a snowball effect. The longer you invest, the more pronounced this effect becomes. Over years, even small, regular investments made consistently can add up to a significant sum, thanks to the power of compounding. Investing isn't gambling or a get-rich-quick scheme. It's not about taking unnecessary risks with your money. It's a smart, steady way to build wealth, based on sound financial principles and a long-term perspective. And it's not just for the wealthy. Investing is for everyone, regardless of their income level or background. Anyone can start, no matter how much money you have. You can begin with small amounts and gradually increase your investments as your income grows. The key is to start early, stay consistent, and develop a disciplined approach to saving and investing, and let time do the heavy lifting. The longer your money is invested, the more it has the potential to grow. Investing is about making your money work as hard as you do, so you can achieve your financial goals and live the life you want. It might seem intimidating, especially when you're faced with complex financial jargon and a multitude of investment options. But once you understand the basics, it's much more accessible than you think. We're here to simplify the process and empower you to make informed decisions. We'll break down everything you need to know step by step, providing clear explanations and practical examples along the way. Ready to see how investing can work for you? Are you excited to take control of your financial future? Let's dive in. Let's embark on this journey together and unlock the potential of investing. Let's break down the basics, the core building blocks of investing. We'll explore the world of finance and investment, starting with the fundamental concepts that every investor should know: stocks, bonds, and funds. These are the primary tools you'll use to build your financial future. Understanding how each of these works is crucial for making informed decisions about where to put your money. Buying a stock means owning a small piece of a company. When you purchase shares, you become a shareholder entitled to a portion of the company's profits and assets. You make money if the stock price goes up, reflecting the company's success and investor confidence, or through dividends, profit-sharing payments distributed to shareholders. These payments are a direct return on your investment. Bonds are different. You're lending money to a company or government. Think of it as an IOU, where the issuer promises to repay the principal amount along with interest. And they pay you interest until they return your original investment at the bond's maturity date. This makes bonds a more predictable income stream compared to stocks. Bonds are usually less risky than stocks because the repayment is contractually obligated, but offer lower returns as a trade-off for that stability. This makes them a popular choice for investors seeking a more conservative approach. If picking individual stocks or bonds sounds overwhelming, and you're concerned about the time and effort required, funds are your friend. They offer a convenient way to diversify your investments without having to research and select each security individually. Mutual funds and ETFs are baskets of many investments, giving you instant diversification and reducing your overall risk. This diversification is managed by professional fund managers who make decisions on behalf of all investors in the fund. ETFs trade like stocks and are easy for beginners, making them accessible and convenient for those just starting their investment journey. Just buy a share and you own a slice of hundreds of companies, spreading your investment across a wide range of businesses and sectors. Mutual funds are priced once a day at the end of the trading day, reflecting the net asset value, NAV, of the underlying holdings. While ETFs can be bought and sold anytime the market's open, providing greater flexibility and the ability to react to market changes in real time. For most beginners, a low-cost ETF tracking the overall market is a great place to start, offering broad exposure and minimizing expenses. It's a simple way to invest in the growth of the entire economy, participating in the potential upside of a diverse range of companies and industries. Now let's talk about cryptocurrency digital money like Bitcoin or Ethereum. Unlike dollars, crypto isn't controlled by any government. It runs on blockchain technology, making it secure and decentralized. People are drawn to crypto for its potential high returns and the idea of a new financial system. Most make money by buying low and hoping prices rise, but prices can swing wildly, sometimes up or down 20% in a single day. Crypto is much riskier and less regulated than stocks or bonds. Scams and hacks are common, so caution is critical. For most people, crypto should be a tiny part of your portfolio, if any at all. Think of it as a high-risk bet, not a core investment. Build your foundation with stocks and bonds first. If you do invest in crypto, only use money you can afford to lose. Don't let hype drive your decisions. Investing isn't new. It dates back centuries. The first stock exchange started in Amsterdam in 1602, letting regular people own a piece of big companies. In 1792, the New York Stock Exchange was born under a buttonwood tree on Wall Street. Over time, investing fueled economic growth, but it was mostly for the wealthy. The Great Depression led to new rules and protections for investors. Mutual funds and later the internet made investing accessible to everyone. Today, anyone with a smartphone can buy stocks in seconds. That's how investing evolved from an exclusive club to something anyone can do. There are two main investing styles, active and passive. Active investors try to beat the market by picking winners and timing trades, but most fail to outperform over time. Passive investing is about matching the market's performance by buying index funds or ETFs that track broad markets. Passive investing is low-cost, simple, and requires little time or expertise. You just buy a fund that holds hundreds of companies and let it grow. For most people, passive investing is the most reliable way to build wealth. It's a set-it-and-forget-it approach. No need to constantly watch the market. Lower fees mean you keep more of your returns. Consistency and patience are your best friends. For beginners, passive investing is usually the smartest path. Ciao. Ready to start? First, open a brokerage account. Think of it as your investing hub. You can use traditional firms like Vanguard or modern apps like Robinhood. Choose between a standard taxable account or a retirement account like a Roth IRA for tax benefits. Funding your account is easy, just transfer money from your bank. Thanks to fractional shares, you can start with just a few dollars. The most important thing is building the habit of investing regularly. Set up automatic transfers so you invest without thinking about it. For your first investment, a broad market ETF like VOO or VTI is a great choice. With one purchase, you own a piece of hundreds of companies. Search the ticker, enter your amount, and click buy. That's it. You're officially an investor. The hardest part is starting, but you've got this. Investing always involves risk, but you can manage it. Rule 1, diversify. Don't put all your money in one stock, spread it across many companies and asset types. Index funds and ETFs make diversification easy. Mix in some bonds for stability, especially as you get older or need your money soon. Your asset mix should match your goals and risk tolerance. Think long-term markets go up and down, but patience pays off. Don't panic and sell during downturns. History shows markets recover. Only invest in what you understand. If it sounds too good to be true, it probably is. Avoid leverage and ignore hot tips or guaranteed returns. Stick to simple, proven strategies. Consistency and discipline are your best defenses. Slow and steady wins the race. Protect your future by staying smart and safe. Let's tackle some of the most common questions that new investors have. We understand that getting started can feel overwhelming, so we're here to provide clear and concise answers to ease your mind. How much do you actually need to start investing? Is it a fortune, or can you begin with a smaller amount, just $1? Seriously, what truly matters is building the habit of investing consistently. It's about establishing a routine and getting comfortable with the process, no matter how small the initial investment. Okay, so you can start small, but how much should you realistically invest on a regular basis? What percentage of your income should you be aiming for? Aim for 15% of your income if you can manage it. This is a great target for long-term financial security and growth, but, and this is crucial, Start with what's realistic for your current financial situation. Don't stretch yourself too thin. Even a smaller percentage is a fantastic start. The important thing is consistency. Is investing just another form of gambling? This is a common concern, so let's address it head on. Absolutely not. Investing is about building wealth steadily over time through informed decisions and strategic asset allocation. It's a long-term game. Gambling, on the other hand, is designed for you to lose money in the long run. The odds are stacked against you, and it's based purely on chance. So with all these options, what's the absolute best investment I can make right now? It depends entirely on your individual financial goals and your investment timeline. There's no one-size-fits-all answer. Are you young and primarily saving for retirement decades down the line? In that case, a broad-based stock index fund is often a great choice due to its diversification and long-term growth potential. But what if you need access to the money relatively soon? Then you should go conservative with lower-risk options like bonds or a high-yield savings account. Are you constantly worried about investing at the absolute wrong time, right before a market downturn? The best advice is, don't even try to time the market. It's a fool's errand, even for professionals. Instead, use a strategy called dollar-cost averaging, which means investing a set amount of money regularly, regardless of what the market is doing at that particular moment. This approach smooths out your average purchase price over time, reducing the impact of market volatility. Ultimately, the key to successful investing is to stay consistent with your contributions and not let fear or market fluctuations derail your long-term plan. Remember, everyone starts as a beginner. No one is born knowing how to invest. So ask plenty of questions, dedicate yourself to continuous learning, and don't be afraid to start small, even with micro investments. Every little bit counts. Trust us, your future self will be incredibly grateful that you started investing today. We've covered the essentials, what investing is, how it works, and how to get started. Investing isn't just for the rich. It's for anyone ready to take control of their financial future. The most important step is to start, even if it's just with a few dollars. Don't let fear or uncertainty hold you back. Inaction is the biggest mistake. Compound growth rewards those who begin early and stay consistent. You don't need to be an expert. Just start with a simple index fund and learn as you go. Set up your account, automate your investments, and stick with it. Building wealth is a marathon, not a sprint. Stay focused on your long-term goals and trust the process. The power to change your financial future is in your hands. Your journey as an investor starts the moment you take action. Why not start today?